The Money Trick. Banks don't want you to know. Chapter 1. The day you realize the game was never fair. Most people will work their entire lives and never understand why they still feel trapped. Not because they are lazy, not because they are unintelligent, but because they were taught the wrong rules by people who benefited from their confusion. From the moment you were old enough to understand money, you were taught one thing above all else. Stay out of debt. Play it safe. Work hard. Save slowly. And for years, maybe decades, you obeyed. You worked overtime. You sacrificed sleep. You delayed your happiness. You tried to be responsible. But deep down, there was always one question you were afraid to ask. If hard work alone creates wealth, why are the hardest working people often the most exhausted financially? Why do people who wake up before sunrise still struggle to breathe under bills? Why do people with degrees, discipline, and decades of labor still feel like one emergency away from collapse? And meanwhile, there are people who seem to move differently, calmer, faster, more strategically, people who use the same system, yet somehow the system works for them. That difference is not luck. It is not magic. It is understanding. Because the truth is this: the financial system was never designed to reward effort alone. It rewards leverage. And the moment you understand that, your entire life begins to change. Welcome to The Money Trick. This is not a book about becoming greedy. This is not a book about showing off wealth online. And this is definitely not a book about reckless gambling disguised as ambition. This is about awareness. This is about learning the hidden behavior of money. This is about understanding why banks become powerful and how ordinary people can finally stop being controlled by the system and begin using it intelligently. Because right now, whether you realize it or not, you are already participating in the game. Every paycheck, every monthly payment, every interest charge, every subscription, every financial decision, you are already inside the machine. The only question is, will you remain fuel for the machine? Or will you learn how to redirect its power toward your own future? There is something banks understand about human psychology that most people never notice. Fear creates obedience. And financially fearful people are predictable. They work, they consume, they borrow emotionally, they repay slowly, they repeat the cycle year after year. But financially aware people behave differently. They ask different questions. They stop asking, how much does this cost? And start asking, what does this produce? That single shift changes everything. A poor mindset looks at money emotionally. A wealthy mindset looks at money structurally. One reacts, the other calculates. One chases appearances, the other builds systems. And systems are where freedom begins. Think about it carefully. A person spends 10 years saving money to buy something outright. Another person learns how to use leverage intelligently and controls the same asset in 1 year. Who moved faster? Who understood time better? Because that is the real secret nobody explains clearly enough. Money is not the highest form of wealth. Time is, and banks know this better than anyone. That is why they lend money. They understand that controlling time creates power. The average person thinks, I need money before I can move. The strategic person thinks, I need strategy before I can move. Completely different psychology. Let's imagine two individuals. The first spends years trying to avoid every form of risk. No investments, no leverage, no calculated expansion. Everything feels safer that way. But slowly, their life becomes smaller. Smaller opportunities, smaller growth, smaller freedom. The second person studies the rules carefully, not emotionally, not recklessly, strategically. They begin understanding cash flow, interest, asset positioning, income-producing systems, and suddenly debt no longer looks like a prison. It looks like a tool, a dangerous tool in the wrong hands, but a powerful one in disciplined hands. That distinction matters because this audiobook is not teaching blind borrowing. It is teaching intelligent control. There are people listening to this right now who have been carrying shame around money for years. Shame from mistakes, shame from debt, shame from financial confusion, shame from feeling behind in life. But shame keeps people passive. Awareness creates movement, and movement creates change. You cannot build a different financial future while emotionally attached to old financial conditioning. You must begin seeing the system differently. You must begin noticing what wealthy people actually do, instead of only listening to what average people repeat. Because average financial advice often creates average financial outcomes. Save every penny. Never use debt. Just work harder. But the wealthy rarely rely only on effort. They rely on structure. That is why some people work for money, while others build systems where money works for them. And that sentence right there might completely alter the direction of your future if you truly understand it. Money working for you. Not emotionally, not magically, systematically. Most people wake up every morning already financially exhausted, before the day even begins. Not because they lack ambition, but because their entire financial structure consumes energy instead of creating momentum. Every payment drains them. Every bill pressures them. Every unexpected expense destabilizes them. But strategic people build differently. They design financial systems that eventually support their lives instead of suffocating them. And it starts with one uncomfortable realization. The bank is not your enemy. Ignorance is. Banks are simply institutions following mathematical behavior. They lend, they calculate risk, they profit from patterns. That's all. The problem is that most people never learn the patterns. And when you don't understand a system, you become vulnerable inside it. That vulnerability is expensive, emotionally, mentally, financially. But knowledge changes your posture. You stop feeling powerless. You stop panicking around money. You stop making decisions from fear. And fear-based financial decisions are some of the most destructive decisions a human being can make. Fear makes people sell too early, borrow foolishly, consume impulsively, avoid opportunities, stay trapped in comfort zones that slowly destroy their future. And comfort can become one of the most dangerous addictions in existence, because comfort often disguises stagnation. There are people who appear financially safe while quietly becoming weaker every year through inflation, rising costs, shrinking opportunity, and dependence on active labor. Meanwhile, strategic individuals are quietly acquiring assets, quietly building ownership, quietly positioning themselves for long-term control. Not flashy, not loud, calculated. That is another lie society teaches people, that wealth is always visible. It usually is not. Real wealth often looks boring in the beginning. Discipline looks boring. Consistency looks boring. Strategic investing looks boring. Until years later, when the results become impossible to ignore. This audiobook, is about those invisible years. The years where your mindset changes before your bank account does. Because financial transformation is psychological before it is mathematical. You cannot outperform financially if you still think emotionally about money. And most people do. They buy emotionally, borrow emotionally, spend emotionally, panic emotionally, then wonder why they feel financially unstable. But calmness is financial power. The ability to think clearly when others react emotionally. The ability to delay gratification. The ability to build quietly while others seek validation publicly. That emotional control alone separates many wealthy individuals from financially overwhelmed ones. And here's something else banks understand that most people overlook. Predictability creates profit. Banks love predictable behavior, predictable borrowers, predictable payments, predictable financial habits, which means the moment you become predictable in discipline, the system begins responding differently to you. Better opportunities, better positioning, better leverage, better terms. Not because the world suddenly became fair, but because you finally learned how the machine behaves. And once you understand behavior, you stop operating blindly. You begin moving intentionally. That is what this audiobook will teach you. Not shortcuts, not fantasies, not fake overnight success, but strategic awareness, the kind that changes how you think forever. Over the next chapters, we are going to dismantle destructive financial myths one by one. You will understand why some debt creates weakness, while other debt creates expansion. You will understand why the wealthy obsess over cash flow, why ownership matters more than appearances, why emotional discipline matters more than income, why time matters more than status, and most importantly, why the people who appear calm financially are often simply operating from a different level of understanding. Because once you stop reacting emotionally to money, you begin seeing opportunities invisible to everyone else. And that is where the real game begins. If this message already resonates with you, take a moment later and ask yourself one question. What financial belief have I been following my entire life without ever questioning where it came from? That question alone can open a door most people never walk through, because the first prison people escape is never financial. It is mental. And in the next chapter, we are going to expose the dangerous illusion that keeps millions of people financially stuck for decades. The belief that income alone creates wealth. Hey there, we want to remind you that we often choose topics suggested by you, our viewers, in the comments. In the comments, you can suggest a topic or ask a question about what you'd like to see in our video. We read every comment carefully, so we promise not to miss a single one. Thank you. Let's keep going. Chapter 2. The Income Illusion. There is a lie so deeply embedded into modern society that most people never question it. A lie repeated by schools, by exhausted workers, by struggling families, by social media, by people who sound financially responsible but quietly remain financially trapped. The lie is this: make more money and your problems disappear. At first, it sounds logical. Of course, more money helps. Of course, higher income matters. But if income alone created wealth, then why are there doctors drowning in debt? Why are professional athletes going bankrupt? Why do executives earning six figures still feel financially suffocated? Why are there people earning enormous salaries, yet living paycheck to paycheck in more expensive clothing? Because income is not the foundation of wealth. Control is, structure is, behavior is, and most importantly, cash flow direction is. Most people increase income without increasing intelligence around money, which means every raise simply creates larger financial leakage, bigger apartment, more subscriptions, new car payment, luxury habits, lifestyle upgrades disguised as success. And slowly, their expenses rise to meet their income like a silent predator. This is why so many people feel confused after promotions. They expected freedom. Instead, they received larger obligations. The system trained them to chase income without teaching them how to protect it. That missing education changes everything. Imagine a man named Daniel. Daniel worked relentlessly through his 20s, early mornings, late nights, no excuses. He believed discipline alone would eventually create peace. And eventually, it looked like he made it. His salary doubled, then tripled. Friends admired him, family respected him. Online, his life appeared successful. But privately, Daniel was exhausted. Every month felt heavier. His lifestyle expanded faster than his freedom. He had the expensive apartment, the luxury vehicle, the premium experiences, the image of success. But beneath the image, there was pressure, constant pressure. The terrifying realization that if his income stopped for even a few months, his entire structure would begin collapsing. And one night, after staring at his bank account, despite earning more money than he ever imagined growing up, he asked himself a question that changed his life forever. How can I earn this much and still feel financially fragile? That question forced him into awareness, because financial fragility is not always visible. Sometimes fragility wears designer clothes. Sometimes fragility drives luxury cars. Sometimes fragility smiles confidently in public, while privately surviving on stress. And banks understand this psychology perfectly. They understand that many people increase spending the moment income increases, which means higher earners often become more dependent on maintaining income instead of less dependent. This is the trap. The modern financial trap is not low income alone. It is lifestyle dependency. Dependency disguised as achievement. Most people never notice when this begins happening. It starts subtly. You deserve this. You worked hard. You can afford the monthly payment. That phrase right there, monthly payment, has quietly controlled millions of lives. Because consumers think monthly. Investors think long-term. Consumers ask, can I handle the payment? Strategic thinkers ask, what does this decision cost me over years? Completely different mindset. One thinks emotionally, the other thinks structurally. Daniel began noticing something uncomfortable once he started studying wealthy individuals carefully. Many people who looked less successful publicly were actually financially stronger privately. They owned assets. They controlled income-producing systems. They prioritized ownership over appearances. And most importantly, their money was working even when they were not. That realization disturbed him. Because Daniel suddenly saw the truth. He had built an expensive life, not a powerful one. And there is a difference, a massive difference. An expensive life consumes resources. A powerful life produces them. One drains your energy, the other compounds your freedom. That was the beginning of Daniel's transformation, not external transformation, internal transformation. He stopped trying to look successful and started trying to become financially difficult to destabilize. That sentence matters deeply. Financially difficult to destabilize. Because true wealth is not about impressing strangers. It is about creating stability, flexibility, and control. The ability to breathe calmly during uncertainty. the ability to survive disruption, the ability to make decisions without panic, the ability to walk away from toxic environments because you are not financially trapped inside them. That is real power. And banks know exactly how rare that level of control truly is, which is why the financially disciplined are often rewarded differently by the system, not emotionally, mathematically. Let's talk about the hidden danger of high income without financial structure. High income creates illusion. It creates the feeling of security. But security without systems is temporary. A person earning modest income with strong asset positioning can survive far longer than someone earning massive income with enormous liabilities. Because liabilities consume, assets support. This is the distinction schools rarely teach clearly enough. A liability takes money from your pocket. An asset puts money into your pocket. Simple. But emotionally, people reverse the definitions constantly. They buy liabilities, believing they are signs of progress. Cars that depreciate, luxury items that lose value, homes too expensive to maintain, lifestyles requiring endless income, and slowly, their future income becomes pre-assigned before they even earn it. This is why some people become prisoners of their own success. Every dollar already belongs somewhere, and banks profit beautifully from this cycle, not because banks are evil, but because the system rewards predictable consumption. The consumer economy depends on emotional spending, impulse, status, comparison, urgency. That is why advertisements rarely sell logic. They sell identity. They sell emotion. They sell the illusion that buying something changes who you are. But strategic people eventually learn something liberating. Your identity should never depend on what you purchase. The moment your self-worth becomes attached to visible possessions, you become financially controllable. And controlled people are profitable. Daniel slowly began changing his financial behavior, not dramatically, quietly. He stopped upgrading everything immediately after raises. He began analyzing purchases differently. Instead of asking, "Do I want this?" he started asking, "What will this produce?" That question transformed his life because suddenly money stopped disappearing unconsciously. Every financial decision became intentional, and intentionality creates power. He began redirecting portions of income toward assets instead of appearances. Small investments first. Nothing flashy. But slowly, his structure changed. Cash flow started appearing from places unrelated to his active labor. And for the first time in his adult life, he felt something unfamiliar around money. Breathing room. Not because he became rich overnight, but because dependence slowly decreased. Dependence on one paycheck. Dependence on appearances. Dependence on constant income expansion. That reduction in dependence creates psychological freedom, and psychological freedom changes how humans operate. Fear decreases, decision-making improves, emotional spending weakens, patience increases, and patience is one of the most profitable financial skills on earth. The wealthy are often not simply smarter, they are calmer. They understand that wealth compounds slowly before it compounds visibly. Most people quit during invisible progress because invisible progress feels frustrating. No applause, no dramatic transformation, no instant validation, just discipline, consistency, strategic repetition. But eventually, the compound effect becomes undeniable. And this is where the real money trick begins revealing itself. Banks understand compounding deeply. Interest compounds. Investments compound. Behavior compounds. Mistakes compound. everything compounds, which means small intelligent decisions repeated consistently become extraordinarily powerful over time. The problem is that most people only experience compounding negatively. Debt compounding against them, stress compounding against them, inflation compounding against them, poor habits compounding against them, but strategic individuals reverse the direction. They make compounding work for them instead of against them. That shift changes entire bloodlines, not just bank accounts. Because financial awareness affects relationships, stress levels, health, confidence, parenting, freedom, everything. Money itself is never just about money. It is about options. And the people with options often appear calmer because they are less trapped. Daniel eventually realized something he wished he learned years earlier. Income creates opportunity, but structure determines whether opportunity survives. Without structure, higher income simply creates larger financial chaos. With structure, even moderate income can slowly create extraordinary stability. That realization is where maturity begins. Not when you earn more, when you think differently. And in the next chapter, we are going to expose one of the most dangerous emotional habits in modern financial culture, using debt to feed the ego. Because the fastest way to destroy leverage is confusing attention with success. Chapter 3, The Ego Trap. There is a dangerous moment that changes many people's financial future forever. It usually happens quietly, not during a crisis, not during poverty, but immediately after progress. A promotion, a business win, a salary increase, a breakthrough year. Suddenly, money starts arriving faster than before. And for the first time in a long time, a person feels powerful, recognized, validated, visible. And that is exactly when the trap opens. Because the moment people begin earning more, the world begins whispering new expectations into their minds. You should upgrade. You deserve better now. People at your level don't drive that. Celebrate your success. At first, it feels harmless. Rewarding yourself seems reasonable, natural, but slowly, without realizing it, many people stop building wealth and start performing wealth. That distinction destroys futures because performing wealth is expensive. Real wealth is strategic. Most people never notice when their financial behavior shifts from intentional to emotional. It starts with one luxury purchase, then another, then a slightly larger apartment, then premium experiences, then status-based spending disguised as self-confidence. And eventually, their lifestyle becomes a machine that demands constant feeding. That machine never stops eating. The terrifying part? Society applauds this behavior. People congratulate visible consumption, not invisible discipline. Nobody sees the investment account growing quietly. Nobody applauds debt reduction. Nobody celebrates restraint. But everyone notices appearances, and weak egos become addicted to being noticed. Banks understand this psychology perfectly because emotional borrowers are highly profitable. The borrower, driven by logic, calculates carefully. The borrower, driven by ego, expands recklessly, and reckless expansion creates dependence. Imagine a woman named Sophia. Sophia grew up watching her parents struggle financially for years. Bills stacked on kitchen counters. Stress hidden behind forced smiles. Arguments about money echoing through walls late at night. As a child, she made a silent promise to herself. One day, I'll never look poor again. That sentence became her hidden motivation. Not freedom, not peace, visibility. And visibility is a dangerous financial motivator. By 32, Sophia was earning more money than she ever imagined possible. Her career exploded quickly. People admired her lifestyle online. Designer brands, luxury vacations, beautiful apartment, perfect photos. Everything looked successful. But behind the scenes, she was exhausted because maintaining the image became a full-time responsibility. Every month required high income just to sustain appearances, and the deeper she went, the harder it became to stop. That is the hidden prison of ego spending. Once your identity depends on lifestyle, downsizing feels emotionally painful, even when financially necessary. Sophia wasn't poor, but she was financially fragile. One disruption, one unexpected loss, one income interruption, and the entire structure would begin shaking. Yet almost nobody around her realized it, because financial instability often hides behind expensive aesthetics. This is why appearances are one of the worst ways to measure wealth. Real wealth is often invisible, calm, private, controlled. Ego-driven wealth is loud, desperate for validation, obsessed with perception, and deeply vulnerable underneath. One night, Sophia sat alone after returning from a luxury trip she technically could afford, but emotionally shouldn't have taken. And for the first time, she asked herself a brutally honest question. Am I building a life or performing one? That question shattered something inside her because suddenly she realized many of her purchases had nothing to do with joy. They were emotional compensation, compensation for insecurity, for comparison, for childhood fear, for wanting external proof that she had made it. And millions of people are trapped in the same cycle right now, buying emotionally, borrowing emotionally, spending emotionally, trying to heal internal discomfort through external consumption. But money cannot permanently solve identity wounds. In fact, unhealed emotions become extraordinarily expensive over time. The wealthy understand something emotionally mature people eventually learn. Confidence does not require constant evidence. Insecure people display. Secure people build. There is a reason some financially intelligent individuals look surprisingly ordinary, because they prioritize ownership over performance, cash flow over compliments, assets over applause. They are not trying to look rich. They are trying to become difficult to control. And that difference changes everything. Sophia slowly began changing her relationship with money, not because she suddenly hated nice things. That is not the point. This audiobook is not teaching deprivation. It is teaching awareness. There is nothing wrong with enjoying wealth. The danger begins when enjoyment becomes emotional dependency. That dependency creates vulnerability. Sophia started noticing how often emotional states influenced her spending behavior. Stress triggered shopping. Comparison triggered upgrading. Loneliness triggered experiences designed for visibility online. This awareness shocked her because she realized many financial decisions were not rational at all. They were emotional reactions wearing financial clothing. And emotional reactions are dangerous when combined with credit access, because debt amplifies behavior. Healthy behavior creates strategic leverage. Unhealthy behavior creates accelerated collapse. The same financial tool, different psychological operator. That is why mindset matters more than most people realize. A financially intelligent person with moderate income can outperform an emotionally reckless high earner over time, because discipline compounds, calmness compounds, intentionality compounds. Sophia began implementing one simple habit that changed her entire financial direction. Before every major purchase, she asked herself, "Am I buying this for utility or identity?" That question became a filter, a mirror, a truth detector, and slowly, her decisions changed, not overnight, but consistently. Some purchases disappeared completely once emotion was removed from them. Others still mattered, but for healthier reasons. And eventually, something unexpected happened. She stopped needing constant external validation because internally, she started feeling stronger. That internal strength affects finances more than people understand. Emotionally stable people make better long-term decisions. They panic less, compare less, consume less impulsively, and strategic thinking becomes easier when emotional noise decreases. Banks, advertisers, and consumer culture all profit heavily from emotional instability. Why? Because insecure people buy faster. Fearful people borrow faster. Impulsive people calculate less. The modern economy feeds on emotional urgency. Limited time offer? Upgrade now. You deserve this. Don't miss out. Urgency bypasses logic, and bypass logic creates expensive consequences. That is why calmness is financial armor. The ability to pause before decisions. The ability to think long-term while others react emotionally. The ability to delay gratification. Most people underestimate how powerful delayed gratification truly is. Because delayed gratification is not denial. It is strategic timing. The wealthy often delay visible rewards while building invisible strength. Then eventually, their assets begin funding the lifestyle naturally. That is completely different from financing lifestyle through debt and active labor. One creates freedom. The other creates dependence disguised as success. Sophia eventually redirected large portions of her spending toward ownership, assets, investments, cash flow systems, long-term positioning, and for the first time, money stopped feeling like a performance. It started feeling like protection, stability, breathing room, choice. That emotional shift changed her entire relationship with work as well, because financially dependent people tolerate environments they secretly hate. Toxic bosses, exhausting schedules, disrespectful treatment. Not because they want to, but because their lifestyle leaves no room for freedom. This is why financial discipline is deeply connected to personal dignity. The more financially trapped someone becomes, the fewer choices they feel capable of making, and choice is one of the highest forms of wealth. This is the hidden danger of ego debt. It slowly steals flexibility, quietly, month after month, until a person wakes up surrounded by expensive things, yet emotionally exhausted by maintaining them. That is not freedom. Freedom is control. Freedom is optionality. Freedom is the ability to breathe during uncertainty. And ironically, many wealthy-looking people are some of the least free individuals financially, because appearances became obligations. The true money trick is not learning how to look wealthy. It is learning how to build a life where money creates calmness instead of pressure. And that only happens when ego stops driving financial behavior. In the next chapter, we are going to uncover one of the most important concepts in modern wealth building: why the wealthy obsess over cash flow, while average people obsess over income. And once you understand the difference between the two, you will never look at money the same way again. We'd also like to remind you that we have a private members community on our channel. All members can vote on the topic of the next video, have priority in the comment section, and, most importantly, gain access to exclusive videos and lessons covering the most relevant topics and information specific to this month. Thank you. Let's keep moving forward. Chapter 4. Cash flow is king. Most people spend their lives chasing income. The wealthy spend their lives building cash flow. At first, those two things sound similar, but they are completely different worlds. Income is what you earn. Cash flow is what continues flowing whether you are working or not. And that distinction, that single distinction, separates financially exhausted people from financially free people more than almost anything else. Society trains people to worship income, higher salary, higher hourly rate, higher bonuses, more clients, more overtime. Everything revolves around earning more, but almost nobody asks the deeper question: what happens if I stop working? That question makes many people uncomfortable because deep down, they know the answer. The income stops. And when income stops for most people, the pressure begins immediately. Bills continue, payments continue, obligations continue, but the money? Gone. That is not control. That is dependency. And dependency creates fear. Banks understand this perfectly, which is why financially dependent people are some of the most predictable participants inside the system. They must continue earning actively. They cannot pause, cannot breathe, cannot step away safely. Their entire life structure depends on continuous labor. And there is nothing wrong with working hard. Hard work matters. But if hard work is the only thing holding your financial life together, you do not own your time. Your obligations do. That realization changes people when they finally accept it honestly. Imagine a man named Marcus. Marcus was respected everywhere. Successful career, great income, beautiful house, luxury vehicle. From the outside, he looked financially powerful, but privately, he felt trapped inside his own success. Every morning began with pressure to maintain, pressure to perform, pressure to continue producing income at the same pace, because if he slowed down even briefly, his entire lifestyle would begin collapsing under its own weight. One evening, exhausted after another 14-hour day, Marcus sat in silence, staring at his expensive home. And suddenly, a terrifying thought entered his mind. What do I actually own? If all of this disappears the moment I stop working? That question haunted him because for the first time, he realized he had built a high-income life, not a financially free life. And those are not the same thing. A high-income life can still be deeply fragile. A financially free life is built differently. The wealthy obsess over cash flow because cash flow creates independence from constant labor, not total laziness, not doing nothing, but optionality, the ability to choose work instead of needing work for survival. That changes a human being psychologically. People who control cash flow move differently, calmer, less reactive, less desperate, because desperation decreases when survival stops depending entirely on active effort. Marcus began studying people who were truly financially stable, not influencers, not people performing wealth online, real financially intelligent individuals. And he noticed a pattern immediately. They focused obsessively on income-producing assets, rental income, business systems, dividend-producing investments, royalties, scalable structures. Their goal was not simply make money. Their goal was create recurring cash flow. Because recurring cash flow changes everything. One-time income disappears, Recurring cash flow compounds. Most people only understand active income. Work equals money. No work equals no money. But strategic people eventually realize that financial freedom is built by reducing dependency on active labor over time. That process takes patience, discipline, awareness, and most importantly, intentional allocation of money. Because the average person spends income, the strategic person redirects portions of income into systems designed to produce future income. That is how the wealthy slowly escape financial pressure, not instantly, gradually, month after month, year after year. Marcus realized something painful. Despite earning enormous income, he had spent years feeding liabilities instead of building enough assets. His money flowed outward constantly: mortgage, car payment, luxury expenses, lifestyle maintenance. But very little flowed back toward him independently. That imbalance creates financial exhaustion, and millions of people live inside that imbalance every single day. High effort, low freedom; high stress, low ownership; high income, weak structure. This is why cash flow matters more than appearances, because appearances do not pay your bills during difficult times. Cash flow does. The wealthy understand this deeply. They know that recurring income creates resilience. Resilience creates patience. Patience creates better decisions, and better decisions compound over time. That compounding effect is the real engine behind long-term wealth. Most people focus only on accumulation, but the wealthy focus on circulation. Where does money flow? What direction does it move? Does it disappear or return multiplied? That question changes everything. Marcus slowly began restructuring his life. Again, not dramatically, quietly. He stopped chasing visible upgrades. Instead, he redirected portions of income toward assets designed to produce future cash flow. At first, the results felt invisible, and that frustrates many people because modern culture is addicted to immediate gratification, immediate rewards, immediate purchases, immediate stimulation. But cash flow building requires long-term thinking. You plant first, then wait, then nurture, then compound. And eventually, something extraordinary begins happening. Your assets start carrying portions of your life, a small percentage first, then more, until eventually you are no longer carrying everything alone. That transition changes the person emotionally, because survival pressure decreases, and when survival pressure decreases, clarity increases. Most poor financial decisions happen under emotional pressure: fear, urgency, stress, desperation. But cash flow creates breathing room. Breathing room creates strategic thinking. That is why financially stable individuals often appear calmer under pressure. It is not because they never experience problems. It is because their entire survival structure is stronger. Cash flow is financial oxygen. Without it, every setback feels catastrophic. With it, problems become manageable. That difference affects health, relationships, confidence, and decision-making more than people realize. Marcus began asking himself a new question before every financial decision. Will this increase future pressure or reduce it? Powerful question. A luxury liability often increases pressure. A cash flow producing asset often reduces future pressure. Once he started filtering decisions this way, everything changed. Not immediately financially, psychologically first, and psychological transformation always comes before financial transformation, because behavior changes before results appear. Marcus also realized why many high earners stay trapped financially for decades. They increase lifestyle at the same speed they increase income, meaning their dependence grows alongside their salary. That is dangerous, because freedom is not created by income alone. Freedom is created by the gap between what you need and what your assets produce. That gap determines flexibility. And flexibility is real power. Banks know this. That is why they respect predictable cash flow. Predictable cash flow signals stability, and stability creates opportunity inside financial systems. The average person thinks, if I make more money, I'll finally relax. But often, higher income without financial structure creates even greater anxiety. Because now there is more to maintain, more pressure, more dependency, more fear of loss. Marcus slowly escaped that trap by simplifying strategically, not becoming poor, not rejecting success, but refusing to let ego expand faster than his asset base. That discipline accelerated his freedom dramatically. This is why many wealthy individuals live below their means for long periods, not because they lack ambition, because they understand delayed expansion, they understand timing, they understand compounding, and most importantly, they understand that visible luxury without invisible strength is dangerous. The world teaches people to admire expensive lifestyles, but financially intelligent people admire strong cash flow. Because cash flow buys time. Cash flow buys patience. Cash flow buys emotional calmness. And calmness is one of the most underrated forms of wealth in existence. Most people are not truly poor financially. They are overloaded. Too many obligations, too much pressure, too little flexibility. And pressure distorts decision-making. Cash flow reverses that, slowly, quietly, powerfully. Marcus eventually experienced something he had not felt in years. Peace around money, not because he became a billionaire, but because dependence decreased, and every decrease in dependence increases freedom. That is the hidden power of cash flow. It restores control over your life. And once a person tastes that kind of control, they never want to return to financial chaos again. In the next chapter, we are going to uncover one of the most misunderstood weapons in modern finance: leverage. Because leverage can either accelerate your freedom or destroy your future. And the difference between those outcomes has nothing to do with luck. Chapter 5. The Power of Leverage. There are two kinds of people in this world: those who spend their entire lives carrying everything alone, and those who learn how to make systems carry weight for them. That difference is a leverage, and once you understand leverage correctly, you begin seeing the financial world through completely different eyes. Most people hear the word debt and immediately think of danger, stress, bills, pressure, mistakes. And to be fair, for millions of people, debt has become destructive. But debt itself is not the true danger. Uncontrolled leverage is, emotion-driven leverage is, ego-driven leverage is, because leverage is like fire. In disciplined hands, it powers industries. In reckless hands, it burns lives down. And the people who become financially powerful are not the people who avoid leverage entirely. They are the people who learn how to control it without letting it control them. This chapter might change the way you think forever, because once you understand how leverage really works, you stop seeing money as something you only earn. You begin seeing money as something you can direct strategically. Imagine a young man named Adrian. Adrian spent most of his 20s believing that saving alone was the safest path. Work hard, save carefully, avoid risk, stay conservative. It sounded responsible, and honestly, compared to reckless spending, it was more responsible. But after nearly 10 years of disciplined saving, Adrian noticed something frustrating. He was moving forward, but painfully slowly. Inflation kept rising. Assets became more expensive. Real estate moved further away. Opportunities accelerated faster than his savings could grow. And quietly, he started feeling like time itself was working against him. That realization disturbed him deeply because for the first time he understood something most people never fully realize. Saving alone is often linear, but leverage can become exponential. That distinction changes lives. Let's simplify it. Imagine someone saves $20,000 every year. After 10 years, they have accumulated $200,000 before investment growth. Respectable, disciplined. But now imagine another person uses $20,000 strategically as leverage toward acquiring an appreciating, income-producing asset. Suddenly, they are controlling something far larger than the money they personally saved. That is leverage. Control beyond direct ownership, acceleration beyond direct effort. The wealthy understand this deeply, which is why they rarely obsess over how much money they personally have. Instead, they obsess over how much value they can strategically control. That is a completely different mindset. Adrian began studying this carefully. At first, leverage terrified him emotionally, because emotionally, most people associate borrowing with weakness. But financially intelligent people understand something different. Strategic leverage compresses time, and time is the most valuable currency in existence. Without leverage, many financial goals take decades. With disciplined leverage, timelines shrink dramatically. That realization made Adrian uncomfortable at first, because he suddenly saw that avoiding all leverage had not necessarily protected him. In some ways, it had limited him. Now, let's pause here carefully. This audiobook is not encouraging reckless borrowing. That distinction matters enormously, because leverage magnifies behavior. If your behavior is disciplined, leverage accelerates growth. If your behavior is impulsive, leverage accelerates collapse. The same tool, different operator. That is why mindset matters more than mechanics. A financially immature person with access to leverage becomes dangerous to themselves. But a strategic person, they use leverage with precision. Adrian eventually met an older investor named Victor. Victor was calm in a way Adrian could not fully understand. Not flashy, not arrogant, not obsessed with appearances, but undeniably powerful financially. And during one conversation, Victor said something Adrian never forgot. Most people think leverage means borrowing money. Real leverage means borrowing time. That sentence changed everything, because Victor explained that strategic leverage allows disciplined individuals to move faster than saving alone ever could. Not magically, mathematically. A mortgage controlling appreciating property, business financing creating recurring income, strategic capital deployed into systems producing future returns. The wealthy were not avoiding debt entirely, they were avoiding bad debt. There is a massive difference. Bad debt consumes, strategic debt produces. Bad debt feeds ego, strategic debt feeds ownership. Bad debt increases dependence, strategic debt decreases dependence over time. That distinction is the entire game. Victor explained something else that shocked Adrian. The middle class often uses debt to buy liabilities. The wealthy use debt to buy cash flow. That single sentence explains decades of financial outcomes. Most people finance consumption, cars, lifestyle upgrades, status purchases, temporary pleasure. But strategic people leverage toward acquisition, assets, ownership, systems, cash-producing structures. One creates pressure, the other eventually creates freedom. And banks know exactly which category most borrowers fall into. That is why financially disciplined borrowers are treated differently over time. Banks respect predictable, strategic behavior, not emotionally, statistically. Adrian slowly began changing his approach to money, not recklessly, carefully. He stopped seeing leverage as something inherently dangerous. Instead, he started seeing it as something requiring emotional maturity. Because leverage exposes character quickly, undisciplined people become exposed under pressure. Disciplined people become stronger. That is why some individuals build empires with debt, while others destroy themselves with far smaller amounts. The difference is not intelligence alone, it is emotional control. Most people underestimate how emotional financial behavior really is. Fear influences decisions. Ego influences decisions. Impatience influences decisions. And leverage amplifies every weakness already present inside a person. That is why financially mature individuals move carefully even when they are ambitious. They calculate downside risk constantly. They ask questions average people rarely ask. What happens if income decreases? What happens if interest rates rise? What happens if the market shifts? What happens if this underperforms temporarily? Because strategic leverage requires survival planning, not blind optimism. Hope is not a financial strategy. Precision is. Victor taught Adrian another principle that became foundational to his thinking. Never use leverage without margin. Margin means breathing room, cash reserves, flexibility, buffer. Without margin, small disruptions become disasters. And many people collapse financially not because leverage itself was bad, but because they operated with no cushion, no reserves, no flexibility, no backup structure. Everything worked until one unexpected event appeared. Then panic took over, and panic destroys intelligent decision-making. The wealthy avoid panic by building margin into their structures. That is why they appear calmer during uncertainty. Not because they are fearless, because they are prepared. Adrian slowly realized something powerful. Financial strength is not about appearing rich. It is about remaining stable during pressure. And leverage used correctly can increase stability dramatically over time. But leverage used emotionally creates fragility. That difference determines futures. Most people only see the upside of leverage. They imagine fast wealth, fast success, fast expansion. But strategic people respect risk deeply because leverage magnifies outcomes in both directions. That is why patience matters. One disciplined decision repeated consistently is more powerful than reckless expansion driven by greed. Greed destroys many people financially because greed removes patience. And once patience disappears, people stop calculating carefully. They chase speed instead of sustainability. That is dangerous. Real wealth is rarely built through emotional urgency. It is built through strategic consistency. Victor eventually told Adrian something that stayed with him forever. Leverage should increase your options, not reduce them. That sentence became Adrian's filter. If a financial decision increased pressure dramatically, reduced flexibility, or threatened stability, it was not intelligent leverage, it was hidden dependency, and dependency disguised as ambition destroys many people. Over time, Adrian built stronger structures slowly. Assets began producing cash flow. Cash flow reduced dependence on active labor. Dependence decreased stress. Reduced stress improved decision-making, and improved decisions accelerated growth further. That compounding cycle changed his life, not overnight, but permanently. The average person fears leverage because they only see stories of collapse. But the truth is, collapse usually begins long before the debt itself. It begins with emotional behavior, impatience, ego, overexpansion, lack of discipline. Leverage simply exposes what already existed underneath. And once you understand that, you stop fearing leverage blindly. You start respecting it intelligently. In the next chapter, we are going to uncover one of the greatest hidden forces silently reshaping wealth every single year: inflation. Because while average people fear borrowing, the financially intelligent often understand how inflation quietly changes the entire game. And once you truly understand inflation, you will never think about money the same way again. Chapter 6. Inflation, the Silent Thief. There is a force quietly stealing from millions of people every single day, and most never even notice it happening. Not because they are unintelligent, but because the theft is invisible, slow, systematic, silent. That force is inflation. And once you truly understand inflation, you begin realizing why so many hardworking people feel like they are running faster every year, yet somehow moving nowhere. Because inflation changes the value of money over time, not emotionally, mathematically. The money sitting still today quietly loses purchasing power tomorrow. And the people who do not understand this become trapped in a dangerous illusion. They think saving money alone is enough. But if your money is losing value faster than it is growing, you're not preserving wealth. You are slowly leaking it. Banks understand this deeply. Governments understand this deeply. The wealthy understand this deeply, which is exactly why financially intelligent people rarely allow large amounts of money to remain stagnant for long periods without strategic purpose. Because stagnant money weakens over time, and inflation rewards movement. Imagine a woman named Elena. Elena prided herself on being safe financially. She avoided risk, avoided investing, avoided leverage, avoided uncertainty. Every month, she saved diligently into traditional accounts. And honestly, compared to reckless spending, she felt responsible. But after years of disciplined saving, something began bothering her. Everything around her became more expensive: housing, food, insurance, travel, health care. Even simple everyday life felt heavier financially, and despite years of saving, she somehow felt financially behind. That confusion frustrated her deeply, because she had done everything correctly, or so she believed. Then one evening, during a conversation with a financially educated friend, Elena heard a sentence that shook her completely. If your money grows slower than inflation, you are becoming poorer, quietly. That sentence stayed in her mind for weeks, because suddenly she realized the game was more complicated than simply saving. Much more complicated. This is one of the greatest financial misunderstandings in modern society. People think financial safety means avoiding movement, but often strategic movement creates far more protection than stagnation. Now let's clarify something carefully. This audiobook is not saying savings are bad. Emergency reserves matter enormously. Liquidity matters. Stability matters. But relying only on stagnant savings while inflation rises year after year can slowly weaken financial strength over time. And the wealthy know this. That is why they focus heavily on ownership, assets, real estate, businesses, investments, cash flow systems. Why? Because many assets historically rise alongside or beyond inflation over long periods. Meanwhile, currency sitting idle slowly loses power. Elena began studying inflation seriously for the first time, and what she discovered changed her entire financial perspective. She realized inflation affects everything. Rent rises, asset prices rise, service costs rise, labor costs rise, which means the cost of waiting often becomes invisible punishment. This is why financially intelligent people obsess over time. Because delaying strategic action for too long can become extraordinarily expensive. And this is where leverage enters the conversation again in a completely different light. Most average people fear debt emotionally during inflationary periods. But strategic individuals often understand something powerful. Fixed-rate debt during inflation can become advantageous. That sounds strange emotionally at first, but think carefully. If inflation causes income, asset values, and prices to rise over time, while your debt payment remains fixed, the relative burden of that debt can actually decrease over years. You are repaying future debt with weaker dollars. That is one of the hidden mechanisms wealthy individuals understand deeply. Inflation punishes savers holding stagnant cash long term, but often rewards owners of appreciating assets financed intelligently. That realization completely transformed Elena's thinking because, for the first time, she saw why many financially powerful individuals were comfortable using strategic leverage during inflationary environments. Not recklessly, strategically. Again, discipline matters enormously here. Emotionally immature people hear concepts like this and immediately become reckless. That is not wisdom. True financial intelligence always includes risk awareness. Always. The wealthy do not ignore risk. They calculate it. They stress test it. They prepare for volatility before it arrives. But they also understand that inflation itself is a risk, a silent one, a long-term one, and ignoring inflation can quietly destroy purchasing power over decades. Elena realized something uncomfortable about her own mindset. She had confused feeling safe with being strategically protected. Those are not always the same thing. Many financially stagnant people feel safe, while their future weakens slowly underneath them. That is dangerous, because invisible decline is harder to notice than dramatic collapse. Most people notice bankruptcy immediately. Few notice 20 years of slowly eroding purchasing power until it becomes painful. This is why awareness matters. Financially intelligent people study forces larger than individual transactions: interest rates, inflation, asset behavior, economic cycles. Because money does not exist in isolation. It moves inside systems. And once you understand systems, you stop reacting emotionally to headlines and fear. You start thinking structurally. Elena began repositioning portions of her financial strategy. Again, carefully. She maintained emergency stability, but she also started allocating money toward assets with long-term growth potential. Not because she became greedy, because she became aware. Awareness changes behavior, and behavior changes outcomes. One of the biggest mistakes average people make is believing financial growth must look dramatic immediately. But real wealth building often feels slow in the beginning, invisible, quiet, compounding beneath the surface. That frustrates emotionally impatient people, which is why many people quit too early, or worse, never begin at all. Inflation rewards patience paired with strategic action, not panic, not emotional reactions, not fear-based paralysis. Elena also realized why financially educated individuals rarely panic during economic shifts the same way average people do, because they understand cycles. They understand that economies move in patterns. Fear rises, fear falls, prices rise, prices fall. But ownership across long periods historically creates resilience. Meanwhile, those relying entirely on stagnant cash become increasingly vulnerable to inflation over time. This realization changed Elena psychologically more than financially at first, because suddenly, money stopped feeling static. She began seeing it dynamically, as energy, as movement, as positioning, not simply something to accumulate and hide. That mindset shift matters enormously. The wealthy rarely ask, "How much money do I have?" They ask, "Where is my money positioned?" Completely different psychology. Positioning determines whether money weakens or compounds. And strategic positioning becomes even more important during inflationary environments. Now let's address something deeper emotionally. Inflation creates anxiety because it exposes lack of control. People feel prices rising around them, life becoming heavier, opportunities moving further away, and without financial awareness, that pressure creates hopelessness. But awareness restores agency, because once you understand the mechanics, you can begin adapting strategically instead of reacting emotionally. That is empowerment. Elena eventually understood something she wished she learned years earlier. Money hidden from inflation is not necessarily protected from loss. That sentence changed her life, because she realized that avoiding all perceived risk had actually exposed her to another type of risk entirely: silent erosion. This is why financial maturity requires nuance. Extreme fear rarely creates intelligent decisions. Neither does reckless optimism. The wealthy operate somewhere different. Calm awareness, calculated positioning, strategic patience. And most importantly, they understand that inflation changes the rules whether people acknowledge it or not. Ignoring inflation does not stop inflation. Ignoring economic reality does not protect against it. Awareness does, preparation does, strategic positioning does. And once Elena stopped viewing money emotionally, she began building differently. Stronger, calmer, smarter. Not overnight wealth, long-term resilience. That became her goal, because resilience outlasts hype. And resilience creates freedom during uncertain times. In the next chapter, we are going to uncover one of the most powerful psychological advantages in finance: why emotionally calm people consistently outperform emotionally reactive people around money. Because in the financial world, discipline is often more profitable than intelligence. Dear friend, you are definitely on the right track. If you are watching this video, like, subscribe, and write in the comments which topic or problem concerns you the most. We promise to prepare a professional video explanation at your request. Chapter 7. Emotional control. The hidden financial superpower. Most people think wealth is built through intelligence alone, but if intelligence were enough, every smart person would become financially free, and that clearly is not reality. There are brilliant people trapped in debt, highly educated people drowning in financial stress, emotionally reactive millionaires losing fortunes they spent decades building, because money does not only test intelligence, It tests emotional control, and emotional control might be the most underrated financial advantage in the modern world. Banks understand human emotions extremely well. Advertisers understand them. Markets understand them. Politicians understand them. Fear moves money. Greed moves money. Urgency moves money. And people who cannot control emotional reactions become extraordinarily easy to influence financially. This is why some individuals repeatedly sabotage themselves even after receiving opportunities, not because they lack knowledge, because emotions overpower structure. Imagine a man named Nathan. Nathan was sharp, very sharp. He understood business, understood investing, understood opportunity, but emotionally, he was unstable around money. When markets rose, he became euphoric, overconfident, aggressive. When markets fell, he panicked, sold emotionally, doubted everything, made impulsive decisions. His financial life looked like a roller coaster, not because he lacked intelligence, but because he lacked emotional discipline. And over time, Nathan realized something painful. The greatest threat to his financial future was not the economy. It was his own reactions. That realization changed him deeply, because for the first time, he stopped blaming external conditions for internal instability. Most people think financial success is about knowing what to do, but often it is about controlling yourself long enough to keep doing it consistently. That is much harder, especially in a world designed to trigger emotional reactions constantly. Fear-based headlines, comparison-driven social media, consumer urgency, market panic. Everything competes for your emotional state, and emotionally unstable people make expensive financial decisions. They chase trends, buy emotionally, sell emotionally, borrow emotionally, consume emotionally, then wonder why money feels chaotic. Nathan began studying wealthy individuals carefully, and something surprised him. The most financially successful people he encountered often seemed boring, emotionally calm, measured, patient. They did not panic quickly. They did not chase excitement constantly. They were emotionally difficult to manipulate. That trait became one of Nathan's greatest obsessions, because he realized calmness itself was creating financial advantage. Think carefully about this. Who performs better financially over 20 years? The person constantly reacting emotionally, or the person consistently making calm, strategic decisions regardless of temporary noise? The answer becomes obvious. And yet, most people spend years strengthening financial knowledge without strengthening emotional discipline. That imbalance becomes dangerous, because knowledge without emotional control collapses under pressure. Pressure reveals emotional weaknesses immediately. Nathan noticed this during market volatility. The moment fear entered the environment, people abandoned logic completely. People sold strong assets impulsively, canceled long-term plans emotionally, made desperate financial decisions for temporary emotional relief. And temporary emotional relief often creates permanent financial consequences. That sentence matters deeply, because many financial mistakes are not mathematical mistakes. They are emotional escape attempts. Trying to remove discomfort quickly, trying to feel safe immediately, trying to regain certainty emotionally. But strategic wealth building rarely feels emotionally exciting moment to moment. Often, it feels repetitive, quiet, patient, and emotionally impatient people struggle enormously with that. Nathan slowly began building emotional systems around money, not just financial systems. That distinction changed everything. Before making major financial decisions, he forced himself to pause, not minutes, sometimes days, because urgency often distorts clarity, and clarity matters more than speed in finance. He also stopped consuming excessive financial noise constantly. Why? Because constant exposure to fear and hype destabilizes emotional judgment. Modern media profits from emotional activation. Fear keeps attention. Greed keeps attention. Outrage keeps attention. Calmness does not generate headlines. But calmness builds wealth. Nathan eventually understood something powerful. The ability to remain emotionally stable during uncertainty is itself a financial asset. Because emotionally stable people continue executing long-term strategy while others collapse into reaction. That consistency compounds massively over time. This is why emotional discipline often outperforms raw intelligence financially. Intelligent but emotionally unstable people frequently sabotage themselves. Meanwhile, moderately intelligent but highly disciplined individuals quietly build extraordinary long-term stability. Discipline compounds. Consistency compounds. Patience compounds. The world dramatically underestimates this. Now let's talk about fear specifically. Fear is one of the most expensive emotions in finance. Fear causes paralysis. Fear causes avoidance. Fear causes emotional selling. Fear causes missed opportunities. But here is the deeper truth. Fear itself is not the enemy. Unmanaged fear is. Emotionally mature people still feel fear. They simply do not surrender decision-making authority to it. That distinction matters enormously. Nathan learned how to separate emotional discomfort from actual danger, because those are not always the same thing. Temporary uncertainty is not always catastrophe. Market fluctuation is not always collapse. Discomfort is not always risk. And emotionally reactive people confuse these constantly. That confusion becomes financially expensive over time. Nathan also discovered another dangerous emotional force: comparison. Comparison quietly destroys financial peace for millions of people. Social media intensified this dramatically. Now people constantly compare lifestyles, income, vacations, possessions, success timelines. And comparison creates emotional pressure. Pressure to upgrade, pressure to appear successful, pressure to move faster than reality supports. That pressure fuels terrible financial behavior. The wealthy understand something emotionally freeing. Most visible wealth is performance, not strength. Real strength often looks quieter, less desperate for attention, less dependent on validation, more focused on long-term positioning. Nathan slowly detached his financial decisions from comparison, and once he did, his spending decreased naturally. Not because he became restrictive, because emotional pressure decreased. That changed everything. Because emotionally calm people spend differently. They invest differently. They borrow differently. They think differently. Emotionally unstable people seek emotional relief through financial behavior. Emotionally stable people seek strategic outcomes. Completely different psychology. Nathan also began noticing how often boredom triggered poor financial behavior. That realization shocked him. People spend because they are bored. Trade because they are bored. Shop because they are bored. Upgrade because they are bored. Modern culture constantly stimulates emotional restlessness. And restless people consume more. But emotionally disciplined people can tolerate delayed gratification without panic. That ability becomes massively profitable long term. Because delayed gratification is the foundation of compounding, the ability to sacrifice short-term stimulation for long-term freedom. Most people intellectually understand this. Few emotionally master it. Nathan slowly transformed financially, not because he discovered secret information, but because he became harder to destabilize emotionally. That is real power, because emotionally difficult to manipulate people make stronger long-term decisions consistently. And consistency creates extraordinary outcomes over decades. The wealthy understand something average people often miss. Protecting your emotional state is part of protecting your financial future. Who you listen to matters. What you consume mentally matters. What influences your emotional reactions matters. Everything affects financial behavior eventually. Nathan eventually created a simple rule that changed his life. No major financial decisions during emotional extremes. Not during fear, not during excitement, not during anger, not during insecurity, only during calmness. That single rule protected him from countless mistakes. Because emotional extremes distort perception. Calmness restores perspective, and perspective creates better outcomes. This is why financial maturity is deeply psychological. Money amplifies emotional patterns already existing inside people. Calmness becomes strategy. Patience becomes leverage. Discipline becomes advantage. And over time, emotionally stable people begin separating themselves dramatically from emotionally reactive ones financially, not through luck, through consistency. In the next chapter, we are going to uncover one of the greatest hidden truths about wealth building, why ownership changes everything. Because the people who control assets eventually control far more than money. Chapter 8. Ownership changes the rules. There is a moment in life when a person finally understands the difference between participating in the system and owning pieces of it. That moment changes everything, because most people spend their lives renting access to things they will never truly control. Renting homes, renting lifestyles, renting subscriptions, renting comfort, renting status, and slowly, without realizing it, they build wealth for other people instead of themselves. This is one of the biggest hidden truths about money. Ownership changes the direction of financial energy. When you own strategically, value begins flowing toward you instead of only away from you. And the wealthy understand this deeply. That is why ownership sits at the center of almost every major fortune ever built. Not labor alone. Ownership. Imagine a man named Elias. Elias worked incredibly hard his entire life. Reliable, disciplined, respected. The type of person everyone trusted. He earned good income consistently for years, but despite decades of effort, he always felt strangely vulnerable financially. One recession created fear. One health issue created pressure. One company restructuring created panic. And eventually, Elias realized something painful. He had spent years helping build systems he did not own. That realization shook him deeply, because suddenly he understood working inside a machine is very different from owning part of the machine itself. Most people are taught to focus almost entirely on earning. Very few are taught to focus on acquiring ownership. And that missing education creates enormous long-term consequences. The wealthy often think differently from the beginning. They ask, how do I gain equity? How do I gain ownership? How do I build assets that appreciate over time? Completely different mindset. Ownership changes financial behavior because ownership creates leverage over time itself. Assets appreciate, businesses grow, systems compound, cash flow expands. Meanwhile, people depending entirely on labor must continuously trade time for survival. That creates pressure, and pressure limits freedom. Elias began studying financially independent individuals carefully, and something became obvious immediately. The calmest people financially often owned assets producing value quietly behind the scenes. Not always flashy assets, not dramatic wealth, but ownership structures, rental income, business equity, dividend-producing investments, intellectual property, scalable systems. Ownership creates layers of financial support beyond active labor, and those layers create resilience. This is why ownership matters so much psychologically, because ownership reduces dependence. The more ownership increases, the less fragile life feels during uncertainty. That is real power, not appearance, not status. Control. Most people misunderstand ownership because they think ownership always requires massive wealth first. But ownership usually begins much smaller than people imagine. The wealthy rarely start with empires. They start with one asset, one investment, one strategic move. Then they compound patiently. That patience matters enormously because ownership rewards consistency over long periods, not emotional urgency. Elias realized something uncomfortable about his own financial history. He had spent years prioritizing consumption over acquisition, not recklessly, but unconsciously. Like most people, society trains people to consume constantly, upgrade constantly, spend constantly, display constantly. But very few people are trained to accumulate ownership strategically. And that difference compounds massively over decades. Every dollar spent has direction, toward temporary pleasure, or toward future leverage, toward consumption, or toward acquisition. The wealthy think about this constantly, because ownership changes the future. A liability often creates future obligations. An asset often creates future options. That distinction matters more than almost anything financially. Elias began redirecting portions of his income toward ownership, slowly. Again, nothing dramatic. Quiet decisions, strategic decisions. And over time, something extraordinary began happening psychologically. He stopped feeling like he was running endlessly just to maintain life, because portions of his financial world began supporting him back. That emotional shift is difficult to describe until someone experiences it personally. The first time an asset produces income independent of your direct labor, your understanding of money changes permanently, because suddenly you realize income no longer has to come exclusively from exhaustion. That realization creates hope, and hope changes behavior. People who feel trapped financially often become emotionally reactive. People who feel increasing control become calmer. Ownership creates calmness because ownership increases options. Options reduce fear, and reduced fear improves decision-making. This is why the wealthy obsess over acquiring assets early, not because they are greedy, because they understand compounding. Every year, ownership compounds. Future pressure decreases. Meanwhile, people focused entirely on consumption often increase future pressure continuously. More payments, more obligations, more dependence. This is why some high-income individuals remain financially weak despite impressive salaries. Income without ownership creates vulnerability. Ownership creates long-term strength. Now let's discuss something deeper. Ownership is not only financial, it is psychological. When people own nothing, They often feel powerless unconsciously, dependent on employers, dependent on systems, dependent on economic conditions. But ownership changes internal identity. Even small ownership changes perspective. You stop thinking only like a consumer. You begin thinking like a builder. And builders move differently through life, more strategically, more patiently, more intentionally. Elias noticed this transformation inside himself slowly. He became less emotionally attached to appearances, less desperate for validation, because ownership created confidence that consumption never could. That sentence matters deeply. Consumption creates temporary stimulation. Ownership creates long-term security. Completely different emotional experience. Most people chase stimulation. The wealthy chase positioning. And positioning determines future freedom. Banks understand ownership power perfectly. That is why they eagerly finance asset acquisition for financially disciplined individuals. Because assets historically produce stability over time. Strategic ownership strengthens balance sheets. Strengthened balance sheets create opportunity. This is also why financially intelligent people often prefer buying assets before upgrading lifestyles dramatically. Because assets can eventually fund lifestyle naturally. But lifestyle without assets creates dependence. That dependence quietly steals freedom year after year. Elias eventually realized something he wished someone told him decades earlier. Every asset you own is a future piece of pressure removed from your life. That sentence transformed him emotionally because he stopped viewing asset building as greed. He started viewing it as self-protection, future stability, future breathing room, future choice, and choice. Choice is one of the highest forms of wealth in existence. Ownership also changes how people experience uncertainty. When everything depends on active labor alone, every disruption feels threatening. But ownership creates multiple foundations, multiple streams, multiple supports, multiple options. That diversification strengthens emotional stability enormously. This is why wealthy individuals often remain calmer during economic uncertainty. Not because they never experience losses, because their structures are stronger. Ownership creates structural strength, and structural strength outlasts emotional panic. Elias slowly built his life differently after understanding this. Less focused on proving success externally, more focused on building invisible strength internally. That shift changed everything. His spending changed. His priorities changed. His relationships with money changed. Because ownership changes identity. You stop asking, "What can I buy?" and start asking, "What can I build?" Completely different future emerges from that mindset. And the beautiful part? This transformation is available long before someone becomes rich. It begins with awareness, then discipline, then consistency, then compounding. Most people dramatically underestimate the long-term impact of strategic ownership because they are addicted to immediate results, but ownership rewards patience more than almost anything financially. The people willing to build quietly for years often become extraordinarily powerful later. Not because of luck, because compounding eventually becomes impossible to ignore. And once ownership starts supporting your life, fear decreases in ways most people never experience. That is real wealth. Not simply having money, having stability independent of constant struggle. In the next chapter, we are going to uncover why financially intelligent people think about risk completely differently than average people. Because avoiding all risk does not create safety. Sometimes it quietly creates stagnation. Dear viewers, write which city you're from. It's interesting to see which corners of the world are watching our videos. Chapter 9. The risk nobody talks about. Most people believe safety comes from avoiding risk. Avoid debt. Avoid investing. Avoid uncertainty. Avoid movement. Stay careful. Stay conservative. Stay comfortable. And emotionally, that advice feels reassuring. But there is a hidden danger buried inside excessive caution, a danger almost nobody talks about honestly. Because while reckless risk can destroy lives, avoiding all meaningful risk can quietly destroy potential. And over time, stagnation becomes its own form of danger. This is one of the greatest financial misunderstandings in modern society. People think safe always means stable. But many financially stagnant people are not truly stable. They are simply slowly falling behind without noticing it immediately. Inflation rises, opportunities move, costs increase, technology changes, economies evolve. Meanwhile, they remain frozen, and eventually life becomes more expensive than their caution prepared them for. Imagine a woman named Claire. Claire did everything right. Stable job, consistent savings, minimal financial risk, no investing, no strategic leverage. She spent years trying to avoid mistakes at all costs, and honestly, people admired her discipline. She looked responsible, predictable, safe. But by 42, something inside her began feeling deeply unsettling. Despite years of hard work, she still felt trapped financially. Housing prices exploded around her. Living costs increased continuously. Opportunities seemed further away every year. And quietly, fear had become the invisible architect of her life. Not wisdom. Fear. Fear disguised as responsibility. That distinction changed everything once she recognized it. Because there is a massive difference between strategic caution and fear-based paralysis. Strategic caution calculates risk carefully. Fear-based paralysis avoids movement entirely, and in a constantly changing world, standing completely still can become dangerous. Claire realized something painful. She had spent years protecting herself from short-term discomfort while exposing herself to long-term vulnerability. That realization shook her deeply, because suddenly she understood that avoiding all risk had not created freedom. It had created limitation. Most people misunderstand financially intelligent individuals. They assume wealthy people are simply more aggressive. Often that is not true at all. The financially intelligent are usually not reckless. They are calculated. They understand something critical. The goal is not to eliminate risk completely. The goal is to manage risk intelligently while still allowing growth. That is a completely different philosophy, because growth always involves uncertainty. Always. Businesses involve uncertainty. Investments involve uncertainty. Ownership involves uncertainty. Expansion involves uncertainty. But so does stagnation. People rarely acknowledge that part. There is risk in doing nothing too. Massive risk. Claire began studying financially resilient people carefully, and she noticed something immediately. They did not fear all risk equally. Instead, they analyzed risk structurally. What is the downside? What is the upside? What is the probability? What protections exist? What margin exists? They approached risk intellectually instead of emotionally. That difference changes outcomes dramatically. Emotionally fearful people often exaggerate worst-case scenarios while ignoring long-term consequences of inaction. Strategic people calculate both, and calculation creates clarity. Claire eventually realized something profound. The absence of movement had become more dangerous than thoughtful movement itself. That sentence transformed her thinking, because suddenly she stopped asking, "How do I avoid all risk?" and started asking, "How do I build intelligently while protecting downside exposure?" Completely different question. That shift marks the beginning of financial maturity. Now let's talk about why fear distorts risk perception so badly. Fear magnifies uncertainty emotionally. The human brain naturally prioritizes immediate pain avoidance over long-term optimization. That helped humans survive historically. But financially, it often creates stagnation, because many long-term rewards require temporary uncertainty first. Most people intellectually understand this. Few emotionally tolerate it well. Claire noticed that many financially stuck individuals shared a common behavior pattern. They overanalyzed action while underanalyzing stagnation. They feared investing losses, but ignored inflation losses. They feared strategic leverage, but ignored decades of lost opportunity. They feared temporary uncertainty, but tolerated permanent limitation. That imbalance quietly shaped entire lives. The wealthy understand something average people often resist emotionally. Risk and reward are connected, not perfectly, not recklessly, but structurally. Greater long-term opportunity often requires measured uncertainty, and measured uncertainty becomes manageable when paired with preparation, discipline, and margin. Margin matters enormously here. The financially intelligent rarely take all or nothing risks. They create buffers, emergency reserves, diversification, cash flow, strategic planning. Preparation transforms uncertainty. This is why wealthy individuals often appear calm during situations that emotionally overwhelm average people, because preparation reduces panic, and panic destroys decision-making quality. Claire slowly began taking small calculated steps financially. Nothing dramatic, no reckless gambles, just intentional movement, learning, positioning, acquiring knowledge, beginning ownership. And slowly, something extraordinary happened psychologically. Her fear started shrinking, because fear often decreases through understanding and action, not avoidance. Avoidance usually strengthens fear long term. This applies financially and emotionally. The people avoiding every meaningful financial step often remain trapped in uncertainty permanently. Meanwhile, those who educate themselves and move strategically build confidence gradually through experience. Confidence matters enormously in finance. Not arrogance, calm confidence. The kind built through understanding systems instead of fearing them blindly. Claire also realized another uncomfortable truth. Many people secretly prefer the comfort of limitation over the discomfort of growth, because growth requires uncertainty. New decisions, new thinking, new behaviors, and human beings naturally resist change psychologically. Even when current conditions are painful, that resistance keeps millions financially stagnant for decades. The wealthy often think differently. They understand that temporary discomfort frequently precedes long-term expansion. That principle appears everywhere in life: fitness, business, relationships, finance. Growth rarely feels comfortable in real time, but stagnation becomes painful eventually too. Claire slowly built a new relationship with uncertainty. Instead of viewing uncertainty as automatic danger, she began viewing it as something requiring intelligent navigation. That changed everything. because once uncertainty stops terrifying you emotionally, you begin seeing opportunities invisible to fearful people. Most financial opportunities exist where uncertainty exists, and emotionally reactive people often avoid them entirely. Now, let's clarify something important. This audiobook is not promoting reckless ambition. Recklessness destroys people, but so does excessive fear. The goal is balance, strategic courage, calculated action, prepared expansion. That is where intelligent growth happens. Claire eventually developed a simple philosophy that transformed her financial future. Small, calculated risks repeated consistently are less dangerous than decades of fearful stagnation. That sentence changed her life because she finally understood something powerful. The greatest financial risk is not always failure. Sometimes the greatest risk is spending your entire life too afraid to build anything meaningful at all. That realization woke something up inside her. And once awareness awakens, people stop living passively. They start designing intentionally. That shift changes futures. The wealthy are not fearless. They simply understand risk differently. They understand that uncertainty is part of growth, and they structure their lives carefully enough to survive volatility while still moving forward. That balance creates resilience, and resilience creates long-term power. Claire eventually noticed something beautiful happening internally. She no longer felt helpless around money, because helplessness decreases once understanding increases. The unknown becomes less terrifying once systems become visible, and financial systems are learnable. That matters deeply. Nobody is born understanding leverage, cash flow, inflation, ownership, or strategic risk. People learn slowly, patiently, consistently, and once they learn, their entire relationship with life changes, because money influences freedom far more than society likes admitting openly. Freedom to choose, freedom to rest, freedom to leave unhealthy environments, freedom to think long-term. That freedom becomes increasingly possible when fear stops controlling every financial decision. In the next chapter, we are going to uncover one of the most dangerous habits keeping people financially exhausted for decades: living to impress people who are not paying your bills. Because the need for external validation quietly destroys more wealth than most people realize. Chapter 10. The Approval Addiction. One of the most expensive addictions in the modern world is not alcohol, not gambling, not luxury. It is approval. The desperate need to be seen as successful, to appear important, to appear wealthy, to appear ahead. And millions of people quietly destroy their financial future trying to impress people who are too distracted to care for more than a few seconds. That truth hurts. But it also sets people free once they finally accept it. Because many financial decisions are not actually financial decisions at all. They are emotional performances. A car purchased for validation, a house purchased for status, a vacation purchased for visibility, a lifestyle purchased to silence insecurity temporarily. And banks profit enormously from emotional spending disguised as confidence. This is why emotional maturity matters more than income. A person earning moderate income with emotional discipline can quietly build freedom. A person earning enormous income with constant validation needs can quietly become financially trapped. The difference is internal. Imagine a man named Jordan. Jordan grew up feeling invisible, not poor enough to attract sympathy, not successful enough to attract admiration, just ordinary. And secretly, he hated that feeling. By the time he entered adulthood, he carried a silent emotional hunger. I need people to see me differently. That sentence unconsciously shaped his financial behavior for years. When his income increased, his spending exploded immediately. Luxury watch, premium apartment, expensive nightlife, designer clothing, every purchase gave him a temporary emotional high. People noticed him more, complimented him more, validated him more, and for brief moments, he finally felt important. But those moments never lasted, because external validation always fades quickly. And when validation fades, insecure people often spend again trying to recreate the feeling. That cycle becomes financially devastating over time. Jordan looked successful publicly, but privately, he was exhausted. Constantly working, constantly maintaining, constantly feeding an image that became more expensive every year. And one night, after feeling strangely empty despite sitting inside a beautiful apartment filled with expensive things, Jordan asked himself a question that changed his life forever. Who am I trying so hard to convince? Silence. That question forced him into brutal honesty, because deep down, many of his purchases had very little to do with actual joy. They were attempts to manufacture self-worth externally, and external self-worth is one of the most expensive financial habits a person can develop. Most people never realize how deeply identity influences money behavior. People spend to feel respected, spend to feel admired, spend to feel accepted, spend to feel superior, spend to feel enough. Very little spending is purely rational emotionally, and advertisers understand this better than most consumers ever will. Modern marketing rarely sells products. It sells emotional identity. You are successful if you own this. You are attractive if you wear this. You are important if you drive this. And emotionally insecure people absorb these messages constantly. That absorption quietly shapes financial behavior for decades. Jordan slowly realized he had confused attention with success. Those are not the same thing. Attention is temporary. Success is structural. Real wealth often looks quieter than social media would have people believe, because financially intelligent individuals are usually less interested in appearing rich and more interested in becoming unshakably stable. That difference matters enormously. The wealthy understand something average people often ignore emotionally. Visibility creates pressure. The more your identity depends on appearance, the more expensive your life becomes. And expensive identities create fragile financial structures. Jordan noticed something fascinating once he started studying truly wealthy individuals instead of influencers performing wealth online. Many genuinely wealthy people looked surprisingly ordinary. Simple clothing, calm energy, no desperation to impress. Why? Because secure people do not need constant evidence of worth. Insecure people perform. Secure people build. That sentence changed Jordan permanently, because for the first time, he realized many of his financial decisions had nothing to do with strategy. They were emotional compensation. Compensation for insecurity, for comparison, for internal emptiness. And emotional emptiness cannot be permanently solved through consumption, only temporarily distracted. This is why lifestyle inflation destroys so many high earners financially. Income rises, and ego rises with it. The person no longer spends based on utility. They spend based on identity maintenance. That becomes dangerous quickly, because once lifestyle becomes emotional armor, Downsizing feels psychologically painful even when financially necessary. Jordan slowly began separating self-worth from spending, not overnight. Slowly and honestly, the process was uncomfortable because many people do not realize how emotionally attached they are to visible symbols of success until they intentionally stop performing them. At first, Jordan worried constantly about what people would think. Would they notice? Would they judge him? Would they think he was failing? But eventually, he discovered something liberating. Most people are too consumed by their own lives to think about yours nearly as much as you imagine. That realization freed him financially because suddenly he no longer felt pressured to maintain expensive performances constantly. And once external validation stopped controlling his financial behavior, everything changed. His spending decreased naturally, not from deprivation, from clarity. He started asking different questions before purchases. Does this improve my future or only my image? Powerful question. Because many purchases improve image temporarily while weakening future flexibility dramatically. And flexibility is real wealth, not appearance. The wealthy protect flexibility obsessively. Why? Because flexibility creates options. That choice changes everything. And maybe years from now, someone will look at your life and assume you were simply lucky. They will not see the discipline, the patience, the emotional control, the awareness. But you will know freedom was built quietly. Decision by decision, day by day, moment by moment. That is how real wealth is created. Not loudly, strategically, calmly, intentionally. So as this audiobook comes to an end, remember this final truth. Money is not power by itself. Awareness is power. Discipline is power. Ownership is power. Calmness is power. Freedom is power. And once you stop fearing the financial system emotionally, you can finally begin using it intelligently instead of surviving inside it unconsciously. That is the money trick. Not becoming controlled by money, but learning how to make money serve your life instead of consume it. If this audiobook resonated with you, take a moment and reflect honestly. What is the first financial habit you're going to change after today? And more importantly, what kind of life are you truly trying to build? Because your future begins answering that question the moment this chapter ends. Thank you for listening to The Money Trick. Banks don't want you to know, and if this journey impacted you, share the line that hit you hardest. What chapter changed your perspective most? And what topic would you like the next audiobook to explore? Until next time, build quietly, think long-term, protect your peace, and never forget, the people who truly win financially are not always the loudest. They are the ones who learned how to stay calm while building freedom in silence.